Welcome back to the Build Wealth Retire Rich series. In our latest videos, we discussed what stock and bonds are. Today, we are exploring one of the most popular investment options, mutual funds. By the end of this video, you'll understand how mutual funds work, their benefits, and what you need to watch out for. Let's get started. A mutual fund is like a team effort in investing. Imagine a group of people, each with different amounts of money, pooling their resources together. A professional fund manager then takes that pool of money and invests it in a variety of assets like stocks, bonds, or even real estate. The key idea here is diversification. Instead of putting all your money into a single stock or bond, mutual fund gives you access to a mix of investments which help reduce risk. When you buy shares in a mutual fund, you essentially own a piece of the entire portfolio. The fund manager decides what to buy or sell based on the fund's goal like growth, income, or preserving capital. For example, some mutual funds focus on large companies like Microsoft or Tesla. Others specializes in bonds or even international stocks. This variety makes mutual funds a flexible tool for different investment strategies. Why are mutual funds so popular? Here are three big reasons. Diversification. With a single investment, your money is spread across multiple assets, reducing the impact of a single stock or bond underperforming. Professional management. You don't have to worry about researching or tracking individual investments. A professional handles it for you. And accessibility. You can start investing with relatively small amount of money. Many mutual funds allow you to start with $500 or even less. Let's break it down with an example. Imagine you invest $1,000 in a mutual fund that focuses on technology, healthcare, and utility companies. Your money is divided into these sectors, giving exposure to companies like Apple, Pfizer, and Duke Energy. Instead of putting all your eggs in one basket, you are spreading out the risk. But mutual funds aren't perfect. Here are a few things to watch out for. Market risk. The value of your mutual fund depends on how the underlying investment performs. If the stock or bond market takes a hit, your fund values could drop. Most mutual funds charge management fees called expense ratio. While they seem small, like 1%, these can add up over time and reduce your returns. And lack of control. You are trusting the fund manager to make decisions, which means you can control the individual stocks or bond in the fund. There are three different types of mutual funds for different goals. For example, equity funds. These focus on stocks for higher growth potential. Bond funds. These invest in bonds offering stability and steady income. And then index funds. These track a market index returns like S&P and usually have lower fees because they don't require active management. So if you're considering investing in mutual funds, here are few quick tips. Check the expense ratio. Lower fees means more of your money stays invested. Understanding the fund's objective, make sure the fund aligns with your financial goals, whether that's growth, income, or capital preservation. Know your risk tolerance. Some funds are riskier than others. Choose one that matches your comfort level. And that's everything you need to know about mutual funds. They are an excellent way to start investing, especially if you want diversification and professional management. Next up in our series, we'll talk about ETFs, exchange traded funds, and how they compare to mutual funds. If you are enjoying this content, don't forget to like, subscribe, and hit that notification bell. Thanks for watching and see you in the next video.